the correlation between those tectonic plates, stock market movement, bond market movement, is greater than it's probably ever been. So if you're looking at one market, let's say you're a gold bug, don't just look at gold. Watch the stock market, watch the bond market. To some extent, watch the dollar index. Correlation there is not that great, by the way, between gold and the dollar index. But as those markets move, it's going to impact gold even more. But gold doesn't always wait for events to happen or a headline report to come out, a CPI or PPI to say, oh, now I can move. No, gold's been around longer than any of these markets. It's smart. It anticipates.
Silver outlook. Will silver eclipse gold amid rising inflation? Silver defies norms, climbing 3.60% despite strong dollar and treasury yields. Fed's upcoming policy decisions critical amidst persistent inflation indicators. Silver ended last week on a high note, closing at $25.19, marking an increase of 0.87 or 3.60%. This upward movement significantly contrasted with gold's modest decline. The trend propels silver towards testing recent highs of $25.91 and $26.14. Differing from usual market patterns, the U.S. Producer Price Index reported a 1.6% year-over-year rise, primarily driven by escalating energy costs. These figures indicate persistent inflation, suggesting the Federal Reserve may extend its tighter monetary policy. The upcoming Federal Reserve meeting is highly anticipated. A hawkish stance from the Fed, suggesting higher interest rates, usually signals a decrease in silver prices. In contrast, a dovish Fed could increase silver's attractiveness by lowering its global cost. Now, we'll show you more clips, but first, subscribe, enjoy the video.
It's the same as a price chart analyst technician drawing lines on his price chart. You know, if you have a stock or an index that keeps coming down to the same price and holding at a given level, that's called a floor, right? Okay, and if you break it, therefore it's negative, okay? Or if maybe you have an uptrend on a price where it hits this trend line 2, 3, 4 times, and if you break it, therefore it's negative. Well, when we look at momentum, we see something different than when we look at price. Price has this upward action since October. This is October, November, December, January, February, March. Okay, now marginal new highs in March. So it's like 5-6 months of rally. When you look at momentum of price, measuring, for example, the monthly price action of the S&P and its relationship to its 3-month moving average, okay, and you plot the oscillator, you don't see an uptrend, you see floor. December low, January low, February low, and now early March low, all at the same level on the momentum chart. So, you know, if it were a price chart and you were looking at it, you'd say, oh my gosh, where do I break it? Well, I'll tell you where you break it. Around 50, we're 15, what would you say our price is now? 50?
51.48.
51.48, okay. About 1% to 2% under their S&P blows that floor. Now, when you look at a price chart, you say, well, gee, dropping back to 100 points under here or 75 under here, that doesn't break anything on price. But on momentum, it blows this massive floor. On the NASDAQ, it's right around or just below today's traded low. You better not close a day there. So in other words, if we see the S&P start to ooze on down later today and tomorrow, much below today's low, and NASDAQ do the same, NASDAQ 100, assume that the monthly momentum topping process, and it's a pretty good size metric. In other words, when it breaks, it tends to go in the new direction for a handful of months. You can't afford that. Because when I go to larger scale yardsticks of the momentum trend measure of the stock market, like quarterly momentum or annual momentum, you can't afford a 5 to 10% drop because you'll blow structures on those momentum charts, indicating we're fully resuming what started in early 2022. Also, if you go back and look at the 2000 top, MSA turned negative in January of 2000, and we cautioned, we said, but be careful, you know, it could wander sideways for a while because we saw some reasons it might. And it even made a new high in August of 2000, above and beyond where we said sell it. And in 2007, we had predicted in 2006, the high would likely be between 1550 and 1600. Well, it took all during 2007, it sort of went sideways. And then finally, with the Fed rate cut, it popped up into that zone and broke out on a price chart, momentum was laughing at it. No breakout on momentum. But price said, oh, look at me. As soon as you started the rollover and got into early 2008, you blew all these structures. And it didn't take much of a price drop to do it. What happened? A massive bear market. We have the same situation now, where you can't really afford to knock the little domino over because there's some bigger dominoes that'll topple and the thing will cascade. So I'd say right now, if you're long the stock market, you don't want it to drop 1% right now.
Gold has garnered a lot of attention in the last few weeks with its record-setting run. Since the end of February, gold is up nearly 7% and set an all-time record of $2,195 an ounce along the way. I've been arguing that silver is drastically underpriced given the supply and demand dynamics for quite a while. With gold setting up for an extended rally, silver could be poised for a record-setting launch of its own, and it just might steal gold's spotlight. Anticipation of Federal Reserve rate cuts and worries about de-dollarization sparked the gold's recent bull rally. I've argued that this is just the opening act. The U.S. government isn't going to suddenly become fiscally responsible or more reserved in using the power of the dollar as a foreign policy tool, so de-dollarization will likely continue and accelerate. When the economy cracks, we all know what the Fed will do. It will run to the rescue. It will slash rates to zero. It will relaunch quantitative easing. It will unleash another tsunami of easy money. What is gold going to do then? If this recent rally based on the hope of rate cuts was this big, the rally we'll see when the Fed actually delivers rate cuts far beyond what anybody today expects will likely send the price into orbit. Now we'll show you more clips, but first like and subscribe to the channel. Enjoy the video.
Right now, our focus is yes, it's on gold, silver, and the miners. And we think that silver and the miners, which have been lagged dogs to the mama market over the last 3 years, where gold's held relatively sideways, now of course upside, they've drifted down. So it's like they don't correlate to gold. Well, they do, but over history, silver and the gold and silver miners will tend to either outperform gold vastly sometimes or underperform it. Well, they've underperformed since mid 2020. They've been going down relative to gold.
Okay.
I think that's going to change. About when you break these monthly numbers that I mentioned that are right below today's low, really, not far.
Mm-hmm.
The likely percentage consequent drop, not the end of the move, just the next phase of the drop is likely to be about 10%. We've got various reasons. I measured both NASDAQ and S&P, and I come up with about 9.5% level on the S&P where I see potential momentum support. You don't see it on price chart. And potential momentum bounce point for the NASDAQ. Not a major buy, just a point where there should be enough support to sort of halt the decline for a bit, maybe get you a bounce. But I think the process, once you break the numbers I specified, just below today's low, for example, on a close, the process is beginning. And those who fear a crash event, a lot of people think, oh, if it crashes, gold will crash. Well, that's not true historically. There's like one time in history where you can connect that. You go back to 87 crash, gold shot up big during that crash, okay? It's only in that October 2008 event where in the middle of its bear market in stocks, there was a month where you dropped drastically. And gold happened to participate for that month and then immediately shot back up to the highs. So as far as a crash event, I think you're going to have to get the S&P. I'll give you a number, and there's a rationale for it, annual momentum. You don't want to see 4,305, 4,305 on the S&P. You don't even want to touch it. Now, you say, well, that's 12 points below. Well, yeah, that's a small double-digit percent. You don't have to drop 30% to get there. You break that level, and you could get a crash-like event. Now, and when you look back to October, the low then was, I think, 4,100. So you're not even breaking that price low, but I'm saying if you get there on momentum, you're blowing out a floor that goes back 3 years. Okay. And therefore you could get horrendous drop. Again, what's the importance of this if you're in gold? It's likely to trigger a cascading data points that the Fed will definitely respond to and aggressively, and they'll flip and they'll go the other way. So will other major central banks. So monetary fluidity will again return, happy times, but it won't help the stock market. It didn't in 2000 to 2002, didn't from 2008 to 2000.
What do you think of today's show? Will Bitcoin outperform gold and silver in 2024? Post in the comments section your price prediction for Bitcoin and tell us if you're bullish on gold and silver. Subscribe if you have not yet done so, and watch this video right here because you'll love it. I see you on the other side.